Hey, what's up, my friend? So, yep, it's been a while and I hope you've missed me. So, today, right, we're going to talk about the trading success formula because here's the thing, right? 95% of traders out there, they do not know what it takes to find trading success. They do not have what it takes to be a profitable trader. That's why you have so many traders blowing up their trading accounts. That's why you have so many traders going around in circles for months, for years, without any results to show for. That's why you have so many traders who give up eventually because they do not have a blueprint, they do not know what it takes to find trading success. So now the question is this: what does it take for you to be a consistently profitable trader, to find trading success? Is it risk management? Psychology? Discipline? No. It's not enough. And it goes much more deeper. And I know what you're thinking. It's not what you're thinking as well. Okay? So I'll break all this down in today's video. So let's get started. The first thing, an age. So what is an age? An age, otherwise known as expectancy, is something that you do repeatedly that yields a positive outcome. Let me give you an example. So let's say, for example, you toss a coin, and every time it comes up head, you win $2. And every time it comes up tails, you lose $1. Now let me ask you, in the long run, will you make or lose money? Well, goes without saying, right? You will make money in the long run. Here's another example. So say this time round you toss a coin, but this time round, every time it comes up to heads, you win $1. And every time it comes up tails, you lose $2. In the long run, will you win or lose? And I'm sure you will say that you will lose in the long run because your losses are larger than your winners. So now the question is this: how do you define an age? Let me explain, okay? So age can be defined as this formula over here. Don't let it scare you because, it's not difficult. Even a 12-year-old can understand this. So let me break this down further for you. Okay, so E stands for your expectancy. Okay, if your E is positive, we say that you have a positive expectancy. Otherwise it means you have a positive age. If your E is negative, then you have a negative expectancy. This winning percentage refers to your winning rate of your trading system. Your average gain refers to how much do you win on average. What is the average size of your gains? What is the average size of your winners? And then likewise, this is your losing percentage, and then this is the average size of your loss whenever you take a losing trade or whenever you take a loss. So let me give you an example so you can see how this works. So let's start with an example of a positive age. So let's say you have a trading system that wins 70% of the time. Every time you win, right, you win an average of, let's say, $80. And every time you lose $100. And needless to say, your losing rate is 30%. How you get 30%? You just take 100% minus your winning rate, 70%, your losing rate is 30%. Okay, so let's say your trading system has this matrix. So what is your expectancy? Just plug in this number, right, into the formula and you will get, let me just walk you through an example, right? So your E is equals to 0.7, which is your winning rate, multiplied by $80, which is the average gain, right, of your winners on average, plus minus your losing rate, which is 30%, 0.3, multiplied by the average size of your losses, which is 100. Okay, so just plug this in. I mean, you don't need to use a calculator. So this first figure would be 56 minus 30, and you get $26. So what does this $26 means? This $26 means that on average, right, after a series of trades, you can expect to make an average of about $26 per trade. So this means, let's say you take 100 trades. How much do you expect your account to be up, to be increased after 100 trades? You can expect your account to be up 26 multiplied by 100 trades, $2,600. So this is the beauty, right, of being able to define your age, your expectancy. Now, this is an example of a positive age, but here's the thing, right? Not all trading systems have a positive age. So let me give you an example this time around of a negative age. Again, we go with a 70% winning rate. But this time around, the average size of your gains is $10. Losing rate is 30%, and the average size of your loss is $100. So this time around, what is your expectancy? So again, using the same formula I shared with you, your expectancy this time around will be negative 23. What does this mean? This means, right, that on average, every time you put on the trade, you can expect to lose $23 on average. Okay, now as you can see, right, in this case, even though you have a 70% winning rate, you have a negative expectancy. But previously in example 3, you also have a 70% winning rate, but you have a positive expectancy. Why is that? What's the difference? Well, the difference here is the size of your average gains relative to your average loss. Some people call this the risk to reward ratio. Yeah, very similar concept. So that is the difference, right? Because in example 3, your average gain is $80, whereas in example 4, your average gain is only $10. So this means that your gains is much smaller than your average loss, and that's why you have a negative expectancy. Now, you might be thinking, so Rayner, does it mean that, your average gains to your average loss is the most important thing? Does it mean that I need to look for a minimum of a 1-to-2 risk-reward ratio? Let's find out. Let's say you have a 1-to-2 risk-reward ratio, okay? Let's say your average gain is twice the size of your loss. So let's say you have a minimum of a 1-to-2 risk-reward ratio. Let's call it your RR, risk-to-reward ratio. Let's say over 10 trades, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Over 10 trades, you have, let's say, a 20% winning rate. Okay, let's say your first 2 trades are winners, and let's say you risk $1 on each trade. So if you have a 1-to-2 risk-reward ratio on the trade, means you make 2 times what you risk. So the first 2 trades are winner and winner. And the remaining 8 trades, let's say they are losses, right? So it's -1, -1, -1, -1, -1, -1, -1, -1, -1. You get the point. So you sum up everything. What is your net return? Well, your net return is -4. -4. This means you have lost money after making 10 trades. In other words, even though you have a favorable risk to reward ratio of a 1-to-2 risk reward ratio, you still have a negative expectancy. Yeah? So what's the point that I'm trying to make? It is this, right? This is something that many traders are just unaware of. It is this. On its own, your winning rate or risk to reward ratio is meaningless. Okay, you need to combine both of them to know whether your trading system has an edge or not. You can't just focus on one. You can't just focus on your winning rate. You can't just look at the risk to reward ratio, because on its own, each of these metrics are meaningless. You need to combine both. Only both of them will you know whether you have an edge or whether you have a positive expectancy. Make sense? So it's kind of like, finding a girl, right? Maybe for a girlfriend or for marriage material. You can't just look at what's outside of the girl, how pretty her face is, because her inside could be horrendous, right? When you want to find a partner to marry, you need to both look at the inside and the outside of the girl. Just like you must have both your winning rate and your risk to reward ratio, right? Both of them, when you combine together, only then will you make a more educated decision to whether you want to marry that girl or whether you want to take that system that has an edge in the markets or not. Now, here's the thing, right? Having an edge itself is not enough. Okay, I repeat, it's not enough, because you also need risk management. So let me explain. So risk management protects your downside no matter what happens, even if you have 10 losing trades in a row. That's the power of risk management, because without risk management, even a profitable trading system, even the best trading system that you know of, will fail. Let me give you an example to see how this works. So imagine this. Imagine there are 2 traders, John and Sally, because that's kind of like the most universal name I can think of, right? Let's say they both have a $10,000 trading account, and they have a 50% winning rate. They have an average of a 1-to-2 risk-reward ratio. So let's say every time they risk $1, if they are wrong, they lose $1. If they are right, they make $3. So 3 times the amount that they risk. John risked $5,000 per trade, and Sally risked $100 per trade. Now, let's say the outcome of the next 10 trades is as follows, right? Lose, 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 and then followed by wins. What do you think is the result of both traders after these 10 trades? So let's find out. So let's talk about John first, right? John. So John, right, is a trader that, either, goes big or goes home. So first 2 trades are losses. So he minus $5,000 and then minus $5,000. So as you can tell, John would have, gone belly up, blown up, right, its account after 2 trades. Now, what about Sally? Okay, Sally. So Sally is more conservative. She only risks $100 per trade. So just let's say minus 100, minus 100, minus 100, minus 100, and then minus 100. Because the first 5 trades over here, 1, 2, 3, 4, 5 are losing trades. But then, because she has sound risk management, she survived to see the better days ahead. So the next 5 trades are winners. Okay, so since it's an average of a 1 to 2 risk reward ratio, her gains are like plus 300, plus 300, 300. I'm just gonna 300 and then 300. Okay, so what's her net profit after these 10 trades? So her total loss over here is negative 500, right? 1, 2, 3, 4, 5, and her total gains is here is 1,005. So 1,005, we'll just put minus 500 plus 1,005. You can see that, just making sure my calculation is correct, because you'll be embarrassed, right, if you can't do this simple math, right, in front of public, all right, and then posting this video on YouTube only to get the math wrong. I don't know where to hide my face. 369, 12, 15, all right, so net gain of $1,000, okay? So in other words, Sally has made a net profit of $1,000 after 10 trades, a 10% gain on her account, whereas John has blown up. And this is where things get interesting. Both of them, right, let me just remove all the drawings. Both of them has a same size trading account, same trading system. The only difference is the amount that they risk per trade. One ended up blowing up his account and one made a gain of 10%. So can you see how important risk management is? Because without it, right, you are given the best trading system in the world, you will still lose in the long run because of a lack of proper risk management. Let's say you have proper risk management. Let's say you have a positive expectancy. Does it mean that you're ready to become a profitable trader? Not quite, because you still need this third thing, discipline. Discipline refers to following the rules of your trading system no matter what happens. Even if you're on a holiday, even if you don't feel like it, even after 10 losing trades in a row, guess what? You still must follow the rules of your trading system. When the setup presents itself, when the opportunity presents itself, you must take it. Yeah? Because what happens if you don't, right, is because if you start skipping trades based on how you feel, based on maybe your emotions, then you end up skipping trades, and let's say the next trade that you're supposed to take, you end up skipping it. That could be a winning trade that could pay for all the little losses that you've incurred previously. But by skipping it, guess what? You don't have the chance to recover from your losses. You're still in the red because you end up skipping your trades. So to kind of illustrate this point, right? Imagine this. Imagine the outcome of your next 7 trades are as follows. Okay, you have 3 losing trades, 1, 2, 3 losses, and then followed by 4 winners. Okay, let's say at this point, right, you have just taken 3 losses in a row. At this point over here, you have taken 3 losses in a row. What is your top process going to be? I think for many traders, their top process is along the lines of, let's say the 4th trading opportunity appears. They are thinking, man, I've just had 3 losses in a row, man. This 4th opportunity is probably going to be a loser. Let me skip this trade. So they skip the trade. And what happens? Their 4th trade happened to be a winner. Now, at the 5th trading opportunity, they're faced with this choice again. Should I take this trade or not? But look at it as a whole, right? Over the last 4 trades, right, 3 of them are losses. Man, the losses, the pain is still there. Emotions is still raw. You know what? I want to play it safe. Let's be more conservative. Let's play it safe. Let's skip this trade. And then guess what? The 5th trade is a winner, which they miss once again. Yeah? And now they are presented with this 6th trading opportunity. And then they look at it. They're in a really tough spot, a dilemma, Man, should I take this trade? The 3 losses, it sucks, but guess what? I missed the opportunity of the recent 2 winning trades. I think right now, the market is about to turn, right? I think right now the system, right, is about to go into a drawdown, right? After all, we have 2 recent winners. This next 3rd trade, or rather this next 6th trade, is likely to be a loser, right? Since, the tide is changing. Let me skip this trade as well. And then, guess what? It's a winning trade. At this point, you can't take it anymore. Yeah? If you had followed the rules of your trading system, right, you would have, been in a much better shape. But because you doubted yourself, you're emotional, you didn't dare to click the button even though you're supposed to do it. But right now you have no choice. You tell yourself, I will follow the rule no matter what. I must follow the rules of my trading system because Rayner says so. So the 7th trading opportunity, you finally decide to take the trade. And finally, you capture this winner. Okay, but because your 4th, 5th, and 6th trade you didn't take, and you only took the 7th trade, which is a winner, that win, right, is not enough to pay for your earlier 3 losses. And overall, you're still down on your trading account. And this is what happens when you don't have the discipline to follow your rules. When you start cherry picking trades to take, when you start to doubt yourself, when you start to doubt the trading system, this is what happens. Yeah. So discipline, right? This is the 3rd ingredient, right, that you need to be a successful, profitable trader. Okay, here's a tip for you, or rather, here is something that you must know. Consistent action leads to consistent results. If you want to be a consistently profitable trader, then you must be consistent with your actions. Because think about this. If your actions are inconsistent, then clearly your results will be inconsistent. So the way to be consistent with your actions is to be a disciplined trader. And if you struggle with discipline, don't worry, later on I have a tip for you. But for now, let's move on and talk about this. Why do most traders fail? And how can you avoid it? So there are a few reasons why most traders fail, and let me break it down to you. Number 1, no risk management and what to do about it. So if you are the type of trader that has blown up multiple trading account, or whenever you have a losing trade, your losses is like 40, 50, 60% the size of your account, this means that you clearly don't have proper risk management, or you do not know how to calculate the optimal position size for the size of your account. Don't worry, right? Because I'm not going to go through a risk management training in this video here, but in the description below this video, I will put trainings on how to master risk management, whether you're trading the Forex market, whether you're trading the stock markets. I will put video tutorials in the description. Just check out the link below and it will benefit you. And the good news is this, risk management isn't difficult. Just give me 30, 40 minutes of your time. You will be able to master risk management. And this is a tool that will pay dividends for the rest of your trading career. Because guess what? Whether you are trading on your first day of your trading career or the last day on your trading career, risk management will be there every step of the way. You need risk management no matter what. Doesn't mean that you are a veteran trader who have been trading for 50 years, you can ignore risk management. No, it's as essential, right, as day one. So don't neglect risk management, and the tutorial will be in the description below. Reason number 2, you don't have an edge in the markets, and what can you do about it? So this scenario is for those of you who understand risk management, but still you suffer losses, quite a few losses. And these losses, right, even though they are not huge, they are starting to eat into your trading account, right? You're suffering what I call death by 1,000 cuts. You're not getting killed by 1 or 2 trades, but 20, 30 losing trades, right? I won't say in a row, but in total, right? And your winners are not enough to pay for your losses. These slowly eat into your trading account. So this is what I call death by 1,000 cuts. So what can you do about this? Well, the problem with this is that you probably don't have an edge in the market. So even though you have proper risk management, your trading system, right, likely isn't working. It's something that's not proven to work in the market. So you need to get an edge in the market. So this is where you need to do things like, testing of trading system, back testing, forward testing, etc. And to make your life easier, you can grab a copy of this new book called Trading Systems That Work. I will equip you with 3 proven trading systems that work, not just based on theory. It's backed by quantifiable data. You can use these 3 different trading systems as a foundation to build your own trading system, or if you want to copy it for your own trading, I leave it to you. And number 3, this one, no discipline, right? If you are the trader that lacks discipline, you know what you should do, you know proper risk management, but you have the struggle of following the rules of your trading system, then this is what I recommend, right? One technique I find particularly effective is to find an accountability partner, someone that you're accountable to. This could be your spouse, your trading buddy, or whoever that you trust. And it goes something like this, right? How does it work? So you will have that accountability partner, check in on you every week to check whether you have followed the rules of your trading system. And you got to be honest, right? Yes, I did follow the rules this week. No, I messed up this week. So that partner will check in with you every single week. And then if let's say you didn't follow the rules of that week, you will then be penalized, getting a punishment. The punishment could be something like treating your accountability partner to a meal, making $50 or $100 to a charity, something that is painful, right? So the pain has to sting a little bit, such that in the future, when you think of not following the rules of your trading system or not being disciplined, you'll be reminded of that pain, right? The pain of getting penalized or getting punished. So this, right, will then help you become a more disciplined trader to follow the rules of your trading system. So I find that having this accountability partner really useful. Okay, to sum up, right, the trading success formula is as follows. It's this. Trading success is having a trading system that has an edge in the markets, you having sound risk management so you don't blow up your trading account, and having the discipline to follow the rules of your trading system no matter what happens, whether you're feeling sick, you're on a holiday, whatsoever. This is the trading success formula. And you can't do, or rather you can't have one without the others. For example, you can't say, oh Rayner, what if I only have risk management and discipline, but I don't have an edge? Then guess what? You'll suffer death by 1,000 cuts. Or what if, someone says, Rayner, what if I only have an edge in markets, but I lack risk management, I lack discipline, and guess what? You will blow up multiple trading accounts. So this is why this is not a buffet where you can pick and choose what you like to eat, like the chicken wings, the creme brulee. No, you got to have all three components. I repeat, you have got to have all three components if you want to be a successful trader. There is no qualms about it. You can't, argue about it. You need these three components. And in this video, right, I have shared insights on how you can achieve, right, or master these three components. Now, you might be wondering, so Rayner, which of these three should I work on first? I'm a new trader, 6 years, or rather 6 months trading experience. Here's my opinion. If you're new to trading, right, work on your risk management first. Why? That's because risk management is the lowest hanging fruit, right, that you can tackle as a trader. All you need is about 45 minutes of your time to learn the math behind risk management and position sizing. The math is not difficult. A 12-year-old will be able to understand it. And you will be able to master risk management. And the importance of risk management is since the first day of trading till the last day of trading, till the day you decide to retire, risk management, right, has to be in place since the day you start trading till the end of your retirement. And it's not difficult to master. 45 minutes is all you'll need. And I will put a risk management training in the description below of this video if you need help on it. Once you master risk management, which isn't going to take long, that's where you need to find your edge in the markets. And if you ask me, based on my experience, that's the hardest part about trading. Finding a trading system that works, finding an edge in the markets. Right? I've spent years looking for this, and this is why I write the book, right? Trading Systems That Work, to help shortcut your learning curve, because it's after years of trial and error, experimenting, testing, I kind of realized, hey, these few trading systems, right, are likely to work for the foreseeable future. And again, if you want to shortcut your learning curve, you can grab the book, right? Trading System that work. And then finally, discipline. Why I put discipline last is because once you have sound risk management, once you have an edge in the markets, your discipline will simply be a byproduct of it. Right? Why do people have discipline problems? Why do they have difficulty following the rules? Well, that's because they don't have conviction in their trading system. They do not know whether it works or not. Is it something wrong with the system, or is it me? All these doubts and struggles in them. That's why they have, or rather they struggle with discipline in following their rules. So once you settle your risk management, once you have an edge in the markets, discipline usually naturally follows along with it. And that's why I kind of put it last. And of course, if you still struggle with discipline, that's where I spoke about earlier, finding an accountability partner, right, to help you with whatever discipline issues you might have. So to recap, number one, trading success is when you have an edge, proper risk management, and the discipline to follow your rules. That is the trading success formula. And why most traders fail is because they lack one of these components in their trading. But when you have all three, you are unstoppable, baby. And by the way, if you want to grab a copy of the book, Trading Systems That Work, you can just go down to this website over here. The link over here is tradingsystemsbook.com. I wish it's called Trading Systems That Work, but that domain is taken up. So tradingsystemsbook.com, I'll put the link in the description as well. You can grab a copy of this book for just, at this price point, it's now $17. And it comes along with a few bonuses, right? But I think what's really interesting is that this is not just a book about one trading system, right? It has three different trading systems, right? First, you have the trend following system, you have the mean reversion trading system, and the breakout trading system. And the exact trading rules, the backtest results are all in the book, right? I don't hide any of the rules or whatsoever from you. So all these 3 trading systems, they are quantifiable, they've been tested, right, and proven to work, right, for the foreseeable future. So again, I'll put the link somewhere below this book. Grab a copy, and for whatever reason, if you're not happy, right, just let me know, right, within the first 180 days. I give you a full 180 days to kind of like test this book, the concepts, the systems. If you're not happy, just email me, right, and I'll happily refund you in full, right, no questions asked. Again, so I'll put the link below this video. Grab a copy, and with that said, I wish you good luck, good trading, and I will talk to you soon.